You must have heard this advice 100 times. Just do SIPs consistently for the long term without worrying about market highs and lows, and one day you will create massive wealth. And to be honest, it's true. In fact, I have even made a separate video with actual data showing how your returns change when you invest at the market peaks and the bottoms. If you haven't seen that yet, check it out first, so that it will help you connect the dots better. Now all that sounds great, but there is one important question hidden in that advice. Everyone keeps saying long term, but how long is the long term mean? Is it 5 years, 10 years or even more? Also, is that long term period the same for large, mid and small cap funds, or does it vary? And most importantly, do we have data to back it up? That's exactly what we are going to uncover in this video. We'll look at 20 years of SIP data across all 3 equity fund categories and find out what long term really means. So the feast is ready, it's time to serve. Let's start with large caps. To keep things simple, we have taken the Nifty 100 Total Return Index and analyzed its SIP returns from April 2005 to March 2025. That's a solid 20 years of data. Now typically when people invest in large cap funds, they assume 5 years is long term. But does the data agree? Take a look at this chart. It shows how SIPs in Nifty 100 performed over different periods like 5, 8, 10, 12 and 15 years. And for each period, we have both the minimum returns and the average returns. Let's start with the 5-year SIP. If you had done a 5-year SIP in the Nifty 100, your average return would have been 13.2%. Sounds good, right? But here's the catch. The worst case return was minus 4.9%, which means in certain 5-year periods, you could have actually ended up with a negative return. Yes, the chances of making a positive return was still 99%, but that 1% risk of capital loss still exists. So clearly, 5 years doesn't qualify as true long term when it comes to large caps. Now look at what happens at 8 years. The minimum return turns positive at 0.7%, which means in every single 8-year SIP period, you never lost money. It's a 100% win rate. And the longer you stay invested, the better the downside protection gets. Also, minimum returns goes up with average return stays healthy right around 13% consistently. What's even more interesting is, if you had done an SIP for 8 years, there's nearly an 80% chance that you would have earned more than 10% returns. So this tells us something important. For large cap SIPs, 5 years is not enough. The real long term starts at 8 years, where your capital is consistently protected. Now let's move on to mid caps. We have taken the Nifty Mid Cap 150 Total Return Index and analyzed the SIP returns from April 2005 to March 2025. Now usually when people invest in mid cap funds, they think 7 to 8 years is good enough to be called long term. But let's see what the data has to say. Take a look at this chart. It shows how SIPs in the Nifty Mid Cap 150 have performed over different periods. And for each period, we have got both the average return and the worst case return. Let's start with the 5-year SIP. The average return was a solid 17.4%. But here's the problem. The minimum return was minus 8.3%. While the average return looks great, in the worst case, you could have actually lost money even after staying invested for 5 years. Now let's stretch that to 8 years, which most investors think is a safe bet. Here too, the average return was strong at 16.7%, but the minimum return is still minus 3.2%. So even after doing everything right and staying invested for 8 years, you could have ended up with negative returns in some cases. That's a bit of shock, right? Now look what happens at 10 years. The minimum return becomes positive at 0.7%, which means no matter when you started your SIP, as long as you stayed for 10 years, you never lost money. A clean 100% success rate. And when you look at longer periods like 12 or 15 years, the minimum returns keep improving and the average returns remain steady, consistently hovering around 17%. Here's the icing on the cake. If you had done a 10-year SIP, there was a 98% chance you would earn more than 10% returns. So what's the takeaway? For mid-cap SIPs, 8 years is not enough. The real long term starts at 10 years, where your capital is consistently protected and your chances of solid returns are much higher. Now let's move on to small caps. We have taken the Nifty Small Cap 250 Total Return Index and analyzed SIP returns from April 2005 to March 2025. Small caps are super volatile. They fall fast and they rise fast. So most investors believe 10 years is long term, especially when it comes to small cap funds. Let's put that belief to the test with real data. Look at this chart. It shows how SIPs in Nifty Small Cap 250 have performed over different time frames. Let's start with the 5-year SIP. The average return was a solid 15.1%, but the minimum return a steep minus 17.6%. That's a big drop. So even after 5 years, there is a real risk of loss. Now stretch that to 8 years. Average return stays strong at 15%, but the worst case return is minus 10.5%, still negative. So even after 8 years, some investors didn't make money. Now comes the critical part, which is 10 years, the time frame most people assume as long term. Here's what the data says. The average return is 15.3%, pretty solid, but the minimum return is minus 0.6%. That's almost break even, but still a small chance of getting negative return exists. So even a decade of SIP doesn't guarantee capital protection. But here's where things start to shift. At the 12-year mark, the minimum return finally turns positive to 3.9% and the average return stays high at 14.3%. Plus you had a 100% success rate, meaning every SIPs were in profit. And here's the sweet part. 87% of those SIPs gave more than 10% annual returns. So the bottom line is, for small cap SIPs, 10 years is just not enough. The real safety zone begins at 12 years. That is when losses disappear and the power of compounding finally kicks in. So if you are investing in small cap funds, think beyond 12 years. Finally, to wrap it up. So next time when someone says, just invest for the long term, you know exactly what to ask. How long is long enough? Because not all long terms are created equal. For large caps, it's 8 years. For mid caps, it's 10 years. And for small caps, it's 12 years. These are the sweet spot where risk reduces and rewards kicks in. So the next time you start an SIP, don't just ask what to invest in. Ask how long you are ready to stay invested. Because that one decision can make all the difference. By the way, now you know how long is long enough for your SIP investment. But do you know how much is much enough to actually reach your goal? If not, don't worry. I have made a detailed video that shows you exactly how to calculate your ideal SIP amount step by step, along with the common mistakes to avoid. And the best part is, I have made a custom Excel sheet to calculate the SIP amount. So you can use it to calculate yours with ease. Make sure to check it out. And that's all for this video. But wait, we saw how doing monthly SIPs for the right time period can reduce your chances of losing capital. But have you ever thought, can choosing a specific date of the month for your SIP maximize your returns? If yes, then what's the best date to do your SIP? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.